Hello everyone, welcome to this special edition webinar for year-end inventory planning tips and tricks with Alyson Distel. Alyson is the president and founder of Edison Business Solutions, which helps small and mid-sized businesses and manufacturers that need QuickBooks help, accounting system analysis, outsourced CFO services. She's a certified QuickBooks ProAdvisor with more than 25 years of combined experience. She's been helping us out a lot. She's a consultant who works with many of our clients, and she's been at the Crunch Retreat. Some of you may have met her at the Crunch Retreat that we throw every year. And Edison Business Solutions brings clarity to the financial side of your business. They can show you how to get visibility into how your business is spending money, allocating resources, whether you're making money, losing money, and why. A clear picture of your financial data, and they can provide CFO level expertise to help you make better business decisions and reduce costs and maximize profits. Alyson specializes in manufacturing based businesses, but also works with companies of other types and helps you with inventory related issues. So Alyson, take it away.
Good afternoon, everybody. As he said, my name is Alyson Distel, and I'm the president of Edison Business Solutions. I'm going to take you through a very light inventory year-end planning tips and tricks. I've been using number crunchers since 2010. Started with all orders and now work with both all orders and order time. So this is focused on order time, but the basic tenets are the same whether you're dealing with order time or all orders. So first we're going to talk about 5 inventory definitions, just basic ones so that we all are on the same page. Average cost, actual cost, FIFO, LIFO, and landed cost. So average cost is the method that's used by QuickBooks. So QuickBooks uses a weighted average that calculates the value of your inventory. So what it does is if you buy 1,000 pieces at $10 and 1,000 pieces at $20, your inventory is going to be worth $30,000. So if you divide that by your 2,000, you now have an average cost of $15. If you sell 500, it's going to multiply the 500 by the 7,500. And it's going to recalculate a weighted average, and your new inventory is going to be an average cost of $17.50 a piece, or $26,250. I know that's confusing, but it keeps sliding the rule. So if your first group that you're selling is the cheaper items, and then you sell the more expensive items, it's going to weight your average to be more expensive ultimately. Every time you sell a cheaper item, it gets more expensive, and vice versa. If you were to sell a more expensive item, it would work its way down. It's a little confusing, but it's all done behind the scenes. The next item or type of inventory is actual cost, and that's quite often used with FIFO and LIFO. And FIFO is first in, first out, and LIFO is last in, first out. So a lot of times people will use a serial number based system or bins. This way you can keep track of what you've actually purchased, when you've purchased it, and actually choose which you want to sell, and that's how you can use the actual cost. But it is not recognized by QuickBooks. So if you use actual cost in order time or all orders, it's not going to match your costs in QuickBooks. You're going to have to make a monthly adjustment. Again, you've got first in, first out, which is FIFO. And like I said before with actual cost, when you sell the 500 with actual cost, you could, if you're doing it in the FIFO method and you're selling the 5,000, which we bought at $10, you then have an inventory value that would be different than the average cost because it's whatever you sold it for. So for instance, your actual cost, if you sell the 5,000, your inventory is now worth 25,000. If you sell $500 at the $20 amount, your inventory will now be worth $20,000. So as you can see, it's more simple arithmetic with actual cost than with average cost. But it's a little bit confusing, but just keep in your mind that QuickBooks only works with average cost. And LIFO is the same as FIFO, only it's last in, first out. So now that you understand some of the terminology, there's one last one called landed cost. And this is the biggest question I get from clients on a regular basis. So landed cost is how much does it actually cost to get your product into your warehouse? And that can be combined of a combination of the item cost, your shipping cost, any duty or other accessorial or service costs. Now, probably of all of my clients, half use landed cost and half use actual cost. The advantage to using landed cost is that you have and keep track of the actual cost of your item, so that when you're selling it, you're taking into account all of these different charges. Your inventory may be a little bit more, have a little bit higher value than it normally would have if you just used the actual cost that you bought it at, but you're going to get a much better cost of goods sold and a much better reflection of how your inventory actually, how much it costs you. So yesterday I was having a conversation with someone and he said to me, well, I have my raw material, I have what I do to it, I have the service that happens, that's my cost. And I said, well, what about the cost to get your item to you, your item from you to the customer, and your item to the third party who's going to manufacture it for you? And he says, oh, I never took those into account. And when we looked at it, we realized that he had $75 worth of charges that he wasn't accounting for, so he really was not as profitable as he thought he was. So landed cost is sometimes very important to keep track of so that you have a much better reflection of how much your inventory is worth. So now that we understand the terminology, let's talk about counts, costs, and quantities. We need to make sure that our inventory is accurate. So 3 items that need to match in order to balance your quantities. And it's pretty logical, but we're going to bring it up anyway. Order time inventory, QuickBooks inventory, and count. Now, it doesn't really matter which 2 you balance first, but you need to balance all 3 of them. So you need to get 2 of them to balance and then balance the third. So some people usually find that the count to order time is the best way to start, but some people like to compare order time to QuickBooks. But that's not always as easy as it seems, and we're going to talk about some of the reasons why you might not match. So once your counts match, you need to confirm that your costs match as well. And there's a little aside here that's saying that you need to make sure that the report that you run in order time or all orders is using average cost, and then you can check to make sure that your average costs are the same between the 2 systems to determine why your costs don't match or do match. So you need to match both your quantities and your values. So let's talk about why inventory might not match. So the first question is, are there any unposted, incomplete, or unsynchronized transactions that reside in order time but not in QuickBooks? That happens quite often where something was left in the processing phase and never was closed, so it never went over to QuickBooks. Another question is, are there any inventory transactions that were erroneously entered into QuickBooks that belong in order time as well? Just remember, order time and QuickBooks only sync in one direction from order time to QuickBooks. So if you put it in QuickBooks, it's not going to get into order time. Are there any entries made directly into the inventory general ledger account on QuickBooks? That's something that people do. They'll make a journal entry directly into the inventory. Well, if you make a journal entry into inventory in QuickBooks, there's no item that corresponds to it. So if there's no item that corresponds, then you're never going to match order time. So that's not a great idea. Better to make a value adjustment or an inventory adjustment to get the information or the data into QuickBooks and or order time. So QuickBooks, as I said before, QuickBooks only keeps track of inventory using the average cost method. Order time can keep track of inventory either way, by average or actual cost. Some people, what they do is they keep their inventory in order time on actual costs, and then they do a monthly true up to make their QuickBooks match what the actual cost is and change it from average cost. They set up an item that does that. So if that is something that you want to do, we can talk offline. I can explain how to do that. So you just need to confirm which method your order time inventory report is using so that you are comparing apples to apples. So let's understand how inventory works between the two systems. It's important to understand how the interface works and when QuickBooks is updated. So inventory synchronizes between QuickBooks and order time 4 different times. On receipt of a raw material, so when you receive in your purchase order, that will trigger the sync to put the items into your inventory in both order time and QuickBooks. When you complete a work order or a kit, it reduces your raw material, and then it increases the finished goods assembly or bill of material inventory on both order time and QuickBooks, because you're leaving the raw material and you're making something new, so it's taking it out of one and putting it into the other. The third time it updates is when you ship. So when it leaves your facility and you finish the ship doc, it will send it over to QuickBooks as an invoice as well. And lastly, if you make an adjustment that's updating inventory, whether the count or the cost, it will update QuickBooks as well. Here is an example of an inventory valuation report on order time. It's a pretty basic one that I printed here, but you can modify it to add additional information should you choose, but for the purposes of this, I made it pretty simple. So you have quantity and you have value and your item. This is a CSV version of the same report. Some people prefer to use it in Excel. The other reason why I like this is because you can manipulate it, you can move things around if you want to compare things, so it makes it nice and easy that you can export it to Excel. Here's the QuickBooks sample, and if you notice, it also has the item, the amount. It includes the average cost, which you can put on the order time report if you so choose, and your asset value, which is basically your on-hand times your average cost. Here are the 2 CSV versions of the inventory, and if you notice, they don't match. It looks to me like the order time one has 785 and the QuickBooks one has 285, so we're off. And if you look closely, it looks like we're off on our chocolate chips by 500 pieces. So the question is why? And our value is off as well for the same reason. This could be due to a number of different things. It could be due to a receiving document, shipped document, or adjustment being posted in order time, but not in QuickBooks. So the thing I would do is check the status on your receiving documents, your shipped documents, or your adjustments to see if there's anything that's still in process that has not been completed. And also check your sync queue to make sure that everything went over. Here's your reports again. Sometimes you might need to make an inventory or value adjustment. Once you've confirmed that everything's been completed, posted, and synchronized between the two systems, and your quantities or values still don't match, that's when you would make an inventory adjustment or a value adjustment. So here's some general hints for adjustments. If your count doesn't match your order time inventory, but the two systems match, you need to make an adjustment to both systems. Make the adjustment in order time and then synchronize. Second scenario, if QuickBooks matches your count, but order time does not, you make the adjustment in order time, but prevent the sync from going to QuickBooks. I'll show you that in a minute. Number 3, if your count matches order time, but not QuickBooks, you need to make an adjustment to QuickBooks only, and you do the adjustment in QuickBooks, and then it will not come back to order time. Lastly, in QuickBooks, the inventory value on your balance sheet should match the total on the inventory valuation summary report. A general rule of thumb, which I mentioned before, never, ever, ever make a journal entry into the inventory account on QuickBooks. Use the adjustment tools to update the inventory. So here's an example of an order time adjustment. So here's the header. It assigns a number, you give it a date, you decide which location you're making the adjustment to. So if you have multiple warehouses, you would choose your warehouse here. The account is the offsetting account, and this is something that confuses everybody. The adjustment is automatically making an adjustment into or out of the inventory account. So it's looking for an offset. Some people use purchases, some people have an overshort and damaged account. Some people have an inventory adjustment account in their expenses or cost of goods sold. So that's what account they're looking for here. Also, if you're working with classes, you put the class there, and then it's asking you for a memo so you can say what you're doing or why you're doing it. This is the body of the adjustment, and basically, if you notice, here's our chocolate chips again. Here's our 500 that are missing, and if you notice in the top right-hand corner, the status says processing. So basically, I never closed it on purpose, so you can see this for the exercise, but I never closed it, so since it wasn't closed, it never went to QuickBooks. So remember a couple slides ago when I mentioned that you can prevent the sync from going to QuickBooks? In the top right-hand corner, under the status processing, there's a little doohickey that my funky arrow is pointing to. And that, if you click on that little doohickey, it will prevent the sync. So that will keep it in all orders only and not send it over to QuickBooks. And lastly, this is the adjustment in QuickBooks. You have an option in QuickBooks to make three different kinds of adjustments. You can do a quantity and total value. You can do quantity only or value only. And basically what you're doing is you're putting in the item and you're saying this is what my new quantity or my new value is, and it will adjust QuickBooks accordingly. So in conclusion, inventory can be easily matched between the systems and to the count. You need to confirm that all of your assemblies and shipping and receiving documents have been completed. Match your count to order time. Confirm that you have synchronized between the two systems. I can't tell you how often that's the problem, that something got stuck in the sync queue and it never went over. Determine which method of inventory you are using. Are you using average cost or actual cost? Match between order time and QuickBooks, and then make any adjustments to quantity and or cost to update your balances if necessary. Please don't hesitate to contact me if I can be of any further assistance or can help you on a deeper level than I went through here. Thank you.
Thank you very much, Alyson. Everybody, I'm gonna send the slide deck out after this webinar in an email, and so I'll make sure that you guys have all those hints that she had in those specific slides, because those are very helpful to write down when you're balancing your end of year inventory. And if you have any questions, now is the time. Click up in the top right. There's a chat button, and you can ask specific questions, and Alyson can answer.
Alyson did such a great job. There's no questions. All questions are answered.
Let's give them like 1 minute, because I know some people, the chat button's at the top. It looks like a message icon with a few lines. What were you saying about the JE method, Ian?
One of the things that Alyson is exactly correct about average costs and stuff like that. And QuickBooks does use the average cost if we're syncing the inventory items. Mm-hmm. And in order time, which is a little bit different than our older product called All Orders, we do have the option of not having any inventory items in QuickBooks, and instead sending over journal entries to reflect the inventory movement. So just another option for companies that have, thousands upon thousands of inventory items, and particularly QuickBooks, or QuickBooks, both actually, QuickBooks Desktop and QuickBooks Online, it just doesn't make sense because it'll slow down QuickBooks significantly. The reports will all run slower. So, you know, we have customers that every year they have to recreate their QuickBooks file because of this problem. And once we do what we did with them, because they don't have any inventory items, QuickBooks runs, you know, much smoother.
True.
So that's that. And I'd like to thank actually Alyson. Alyson's been working with us for a long time. She's an expert in her field, and she's a great person.
And
So thank you, Alyson, for taking the time.
Thank you. Thanks everybody for listening.
yeah, it looks like we don't have any specific questions, but if anyone wants to email Alyson after this, we'll include all of her information in the final email. Have a good one, everybody.
Bye-bye.
All
Bye now.
Bye.
Bye.